there's probably some concerns around AI, some concerns around Nvidia. We obviously have the volatility around tariffs, right? Yes, of course. But I guess when I look now into the future, is that really, or is what we've seen, is that really the beginning of sort of a 10% correction in equities? I mean, to be honest, on the one hand, I kind of wish it was, because you'd be like, okay, there's finally a dip that we can buy, right? Because let's be honest, in the last 2 years, even last year with the carry trade unwind that we had, it was sort of over in 2-3 days.
Yeah.
So, like my fingers aren't quick enough to be writing buy the dip, and the dip is already gone. But the problem is, I guess the positioning is just simply not there. So even in the last couple of weeks, we've never really had in all of our data positioning that was super, super exuberant. So one thing that clearly it was not was exuberant positioning, which actually going forward is pretty encouraging. We look at some of the surveys yesterday, we've got the AAII, right? And it already is comfortably below the first percentile over the last, I think, 40 years or 45 years of history, which is crazy. We're of course, the S&P is off its all-time high, but we're a handful percent of its all-time highs. High yield spreads have barely budged, IG spreads have barely budged, and sentiment is already so depressed, particularly on the surveys. That just tells me going forward, we're probably much closer to, again, buying the dip territory rather than having a full-blown correction.
So what is buying the dip territory? When you look at levels here, when would you be encouraging your clients to step in? When would you see the bottom? Yeah,
I mean, we haven't changed our stance. We're still sort of medium overweight equities, even in the US, also in the Eurozone, in EM, in China. But really most overweight in high yield credit, in emerging market credit, in emerging market rates. So it's really the carry assets, the high beta carry assets that we do like the most. Because let's be honest, what we're seeing right now is we are starting from a much higher level of yields. Spreads may be tight, but any kind of material weakening in spreads that we might see, or any kind of material spread widening, even like the last few days, that is then typically counteracted by a decline in yields. That's exactly what we've seen. If you look at total returns in high yield, whether that's euro high yield, dollar high yield, whether that's emerging market rates, whether it's emerging market credits, if you look at it the last 4 weeks, you'd have barely thought there's any volatility. You'd barely have thought there's volatility around rates, around Magnificent Seven, around DeepSeek, AI, Trump, tariffs. No, you'd be like, it's just a straight line upwards. And that, to me, at the moment is, I think, from an asset allocation perspective, by far the best thing that really I'm still staying bullish and the most bullish on right now.